Welcome back to the deep dive. Today we're tackling what I think of as the engine room of managerial finance, cost volume profit analysis, CVP.
Right. And what our sources make really clear is that CVP isn't just about spreadsheets.
No, it's a skill set. It's about blending two, fundamentally different ways of thinking. You have the rigorous algebraic math that gives you that exact number.
The precision.
The precision, yeah. But you also have the visualization, the graph, that gives you that instant crucial intuition. You really need both working together.
That's the key. Our mission today is to move you past just, calculating a break-even number. We want to show you how that number and the entire cost structure behind it is, well, visually represented.
Okay.
By understanding the synergy between the formulas and the graphs, you gain this complete framework. It allows for, lightning-fast risk assessment and surgically precise calculations.
Okay, let's unpack this then. Our source material, it's everything from these specific financial puzzles to some really detailed graphical guides. We're going to start with the fundamental algebra, the raw numbers.
Exactly. The raw numbers, because that's the foundation. That's where the precision we absolutely need comes from. So when we dive into the math of CVP, we're really dealing with four central players. You've got fixed costs, variable costs, net income, and this essential concept of the contribution margin, CM.
And that CM, that's the money left over after you cover the variable costs of producing just one unit.
I always think of it as the fuel for the business. It's the pool of funds that first pays off all your fixed costs, and then everything after that, well, that's your profit.
And the fundamental identity here, it's what gives us our predictive power. It's simply net income equals your total contribution margin minus your total fixed costs.
It seems so basic.
It does, but understanding how changes in these components interact, that's where the real management genius lies.
And that's where operational leverage comes in, right? It's that multiplier effect. Let's look at a specific scenario from our sources to see this in action. The Hayburn Company scenario.
They managed to decrease their total fixed costs by a solid $6,000, and at the same time, their total contribution margin went up by $12,000.
Right, and most people's first instinct is just to add those two numbers. But you have to go back to the formula. The change in net income is that $12,000 CM increase. But remember, the fixed costs decreased. So you're subtracting a smaller number. Mathematically, it's 12,000 minus a negative 6,000.
Which means the net income didn't just go up by 12 grand. It saw this surprisingly large immediate jump of $18,000.
Exactly.
And that single data point is so instructive. It really confirms that the biggest impact on profit often comes from managing that cost structure, especially fixed costs, not just relentlessly driving more sales.
Precisely. Now let's talk break even, the zero profit benchmark. Let's look at the Irish company example.
Okay.
They sold 100,000 units at $5 a unit, and they hit break even exactly. We know they had $150,000 in fixed costs.
So break even means total revenue equals total costs. And their revenue was what, $500,000?
$500,000, right. So the algebra forces us to solve for that unknown, the variable cost per unit.
Well, if total revenue is $500K and fixed costs are $150K, then the rest, the remaining $350,000. That must have gone to cover the variable costs.
Across all 100,000 units.
Yeah.
So you just divide that 350,000 by the 100,000 units.
And that tells us the variable cost per unit had to be exactly $3.50.
That's the power of the algebra. You can find the precise figure for any missing piece.
So we've got these exact verifiable targets. But here's the problem, right? These numbers on their own, they don't really give you a feel for the terrain. They don't immediately show you if Irish Company's $1.50 contribution margin is strong enough to handle, say, an unexpected 10% drop in sales.
And that's where visualization steps in.
That's where we need the map.
Exactly. The math gives us the coordinates, but the graph gives us the map. And to get that intuition, we have to look at the geometry of costs. The starting point, the golden rule for graphing, has to be crystal clear.
The axis is always dollars.
Always dollars cost or revenue. And the x-axis is always your activity level. Units, hours, whatever it is.
Okay, so with those axes set, we can plot the three fundamental cost behaviors. First up, variable costs.
Right. Think raw materials.
It starts at 0, 0, no production, no variable cost, and it just rises steadily. The steepness of that line, that slope, that's your variable cost per unit.
Then you have the fixed cost graph. This is your rent, your CEO salary. Within a certain production window, the relevant range, this cost doesn't change.
So it's just a flat horizontal line.
A flat horizontal line. It's your invisible financial floor.
And third, you combine them. You get the total cost graph. It doesn't start at the origin. It starts up on the axis, right at that fixed cost line.
And from there, it goes up with a slope that's exactly equal to your variable cost per unit. It's a total bill for everything.
Okay, so now we put it all together into the complete CVP graph. We plot that total cost line we just talked about, the horizontal fixed cost line.
And the revenue line,
Yeah.
which starts at 0, 0, and has a slope equal to your selling price.
And the moment of truth is where that revenue line and the total cost line cross, that intersection.
That's the break-even point. Profit is exactly 0.
And the really crucial intuitive insight here is you can see the risk.
Yes. Everything to the left of that intersection is the loss area. Costs are higher than revenue. Everything to the right,
That's the profit area.
profit area. And the angle between those lines, that shows your operational leverage. The distance from where you are to that break-even point, that's your margin for error.
Okay, so here's where it gets really interesting for me. Once you understand that structure, you can actually work backwards. You can reverse engineer the math just by looking at the graph.
You can turn the picture back into the audit. Yes, let's try that. Take the example graph where the total cost line starts on the y-axis at $2,300.
Okay.
Well, that's the y-intercept of the total cost line. So right away, you know your fixed cost is $2,300. It's just sitting there.
Okay, that's easy enough. What about price per unit?
For that, you look at the slope of the revenue line. Let's say the line goes from 0 up to $7,000 in revenue over a run of 2,000 units.
So, rise over run. 7,000 divided by 2,000, that's $3.50 per unit.
Exactly. That's your price. And now, finally, the variable cost per unit. We just need the slope of the total cost line.
Okay.
So let's say that line climbs to $5,000 at 2,000 units. The rise from the variable cost is that $5,000 total minus the $2,300 fixed cost floor.
Which leaves $2,700.
Right. And $2,700 divided by that same 2,000 unit run means your variable cost is $1.35 per unit.
So, hold on. You said yourself that a graph is really just an estimate. How can a manager rely on this if the real fixed cost was, I don't know, $2,305? Isn't the graph just a dangerous simplification at that point?
That is an essential question. And the answer is the graph provides the intuition, the quick estimate, but the algebra provides the proof, the non-negotiable proof.
Okay.
We use these extracted values now to verify it algebraically. We take the price, $3.50, minus the variable cost, $1.35. That gives us a contribution margin of $2.15 per unit.
And if we divide the 2,300 in fixed costs by that 215 cm per unit, we get a precise break-even of about, what, 1,070 units?
Roughly 1,070 units, yes. So now you look back at your graph, and if those lines cross right around 1,070, you can trust the visual, because you know the algebra confirms the detail. It's that trust but verify approach.
Trust but verify. I like that.
Right. But sometimes a manager doesn't need to see all the components. They just want the answer, the bottom line.
Which brings us to the profit graph. I think this is a brilliant simplification. It just boils the entire CVP analysis down to a single line.
It does. And to build it, you only need 2 points. First, at 0 units, what's your profit? It's actually a maximum loss equal to your fixed costs. So for example, a negative $63,000 loss.
That's point 1.
Point 2 is your break-even point. Let's say that's at 700 units. Well, at break-even, your profit is exactly 0. You connect those 2 points, and that's your profit line.
So what's the big revelation here? What does the slope of that single line represent?
It represents the single most important metric in CVP, the contribution margin per unit. Using our example points, the line rises $63,000 over a run of 700 units. The slope is $90 per unit. It means for every single unit you sell, you are visually marching up that profit line by $90. The steepness is a direct visual of your profit velocity.
Okay, let's anchor this. Let's apply both graphs to the Rock company data from the sources. They sell rock by the ton. They have a fixed cost of $60,000, a variable cost of $4 a ton, and a price of $6 a ton.
So that gives them a contribution margin of $2 per ton, which means their break-even point is exactly 30,000 tons.
30,000 tons. So if we draw the CVP graph, the fixed cost line is flat at 60K. The intersection, the break-even, happens at 30,000 tons, where total revenue is $180,000.
And that graph, it instantly communicates their really high-cost structure.
Okay, now let's compare that to the profit graph for Rock. It starts way down at a loss of negative 60,000.
And crosses that 0 line at exactly 30,000 tons. Every ton after that drives profit up by that $2 CM slope.
So if a manager wanted a quick estimate of profit at, say, 40,000 tons, they just trace the line up and see it's about a $20,000 profit,
And this is where we can bring in another critical strategic concept, the margin of safety.
which is how far your sales can drop before you start losing money.
Exactly. On the CVP graph, it's the physical distance between your current sales volume and that break-even intersection.
So if Erderock is selling 40,000 tons, their margin of safety in units is 10,000 tons. 40,000 minus the 30,000 break even.
And you can verify that. 10,000 tons at a $2 CM is a $20,000 safety cushion. Visually, that gap is your buffer zone.
So this comparison really shows why managers need both types of graphs. The CVP graph is best for understanding the cost components.
It visualizes that massive $60,000 fixed cost floor. It helps you understand why profits are changing by showing the relationship between revenue and the total cost structure.
But the profit graph, that's the master of operational leverage. It shows the bottom line.
Because it's only one line, its steepness is the contribution margin. A steep line means high leverage. Once you pass break even, every sale brings in huge profit.
And a flatter line means less risk, but also, slower profit growth.
The ability to visualize these risks, the margin of safety gap, the steepness of the profit line, and combine it with the precision of the algebra, well, that allows for truly informed, confident decision-making.
And we should do a quick check on the limitations. The sources are clear that graphs are fantastic for intuition, but they are still visual estimates. That little bit of uncertainty.
Is it 2,300 or 2,305?
Right, and that's why we always verify with the algebra and also the relevant range restriction.
Absolutely. If Erderock suddenly needs to sell 100,000 tons, they might have to build a new quarry. That $60,000 fixed cost line will jump, making the whole graph obsolete.
So we started with this dual nature of CVP, and we've really confirmed that both sides are essential. We went from the algebraic rigor of the formulas
to the immediate, intuitive visualization of the graph.
Yeah, the CVP graphs showing the components and the profit graphs simplifying it all down to that bottom line result.
And if you connect this to the bigger picture, the real managerial advantage here isn't just calculation, it's communication. The power of this integrated approach is that you can take complex financial insights and communicate them simply.
The graph gives the visual context.
Exactly. A shared understanding for the team, while the algebra provides the exact numbers they are required to hit.
Now that you understand how both types of graphs show the exact same information, consider this. If a company's business model requires a really high fixed cost investment, like Erderock's $60,000, they face a lot more upfront risk. How would that business use the resulting steepness of its profit graph, that high operational leverage, to communicate the massive potential reward to investors compared to a competitor that has really low fixed costs and a much flatter, safer-looking profit line? Keep exploring.